Good day, everyone. My name is Oladipo A. We're Team Fish and Chips. We're here to present the auditing standards and the difference between the UK and the US. The agenda for our presentation is basically going to cover professional qualifications and the differences between the UK and the US, and history of auditing standards in the UK, comparison of those auditing standards, and auditing issues that exist in the UK. Also, we're going to cover the differences between the audit report in the UK and the US. The qualification in the US is called the Association of Chartered Certified Accountants, ACCA for short. It is equivalent to the CPA in the US, and the ACCA basically has two major requirements: the examination and experience. As far as the examination goes, there are 14 parts to the examination, and you can basically start taking them right after high school, basically. The 14 exams are grouped into 3 parts, which is called, they call it knowledge, skills, professional, which is basically introductory or fundamental accounting. Intermediate accounting is referred to as skills, and professional is equivalent to advanced accounting. Basically, at the end of the examination, when you get your license, you can also get a bachelor's in applied accountancy from Oxford University. The ACCA has an accreditation or a deal with the Oxford University. And depending on your level of education, you could also qualify for some exemptions. Students in the MSA program for CSUN basically qualify to start taking the exam from the professional level. So you would have to take P1 through P3 and choose 2 from P4 through P7. And the maximum exemption you qualify for is basically F1 through F9. You cannot get any other exemptions beyond that, basically. And as far as the cost goes, it's kind of grouped into 3 stages or windows, if you want to call it that. If you come in the early stage, it's more cheaper, and that is basically because most of the exams at the early stage are online exams. The standard is a mixture of both, and the late is the most expensive, and I think it's also covers online and written examinations also. The experience requirements, it's a 3-year experience versus the US, which is depending on what state you are, between 1 and 2 years, and depending on what you want to pursue in the US, it's between 1 and 2 years experience requirements. And your experience has to cover 13 areas to get your license, basically. The areas include professionalism, ethics, governance, personal effectiveness, business management, and depending on what concentration you want to choose, you could go for auditing and assurance, or if your focus or your interest is taxation, you make sure your experience covers preparing taxes or tax issues, basically. And at this point, I am going to pass it on to Bree, and she's going to talk about the timeline for the audit standards.
Thank you. I'm Bree, and I'm going to talk a little about the history of the auditing standards through a timeline, and then talk about the differences between the principles-based audit standards and rule-based audit standards. So to start off with the timeline, prior to 1976, guidance was published by the professional bodies, and then in 1976, the Auditing Practices Committee was established, and they provided a framework for judgment, had explanations on guidance and auditings, and defined the auditing standards. And then in 1980, the APC published the first auditing standards and guidelines. The first standard was the Auditor's Operational Standard, and the first guideline was planning, controlling, and recording. In 1989, the APC issued a series of practice notes, and those were practicing guidelines to assist auditors in applying standards for particular circumstances or industries. And in 1991, the APC was replaced by the Auditing Practices Board, and they adopted the practice notes that were already put in place 2004, the Financial Reporting Council was established, and the APB became a subsidiary board of them. The FRC was in charge of monitoring and enforcing the audit standards. And also in 2004, the APB issued international standards on auditing, which were applied to audits after December 15, 2004. In 2009, the International Auditing and Assurance Standards Board updated and reformatted the ISAs. They improved the understandability to make it more compatible with regulatory frameworks. And the revised ISAs applied to audits after December 15, 2010. And finally, in 2012, APB was replaced by the Audit and Assurance Council, and they acted as an advisory role to FRC for developing audit standards. So now I'm going to talk a little bit about rules-based versus principles-based. The UK has a more principles-based approach when the United States has rule-based, and the UK strongly believes that a principle-based approach is better because it improves audit quality. Principles balance professional judgment with auditor accountability. Standards shouldn't replace proper training or maintenance of ethical standards of professional integrity. Auditors should have the necessary skills and knowledge to make a high-quality audit decision based on their professional judgment, not on precise, detailed, and long rules. Unfortunately, over the last decade, there's been a lack of trust in auditors, and so they have developed more rules, and more rules aren't necessarily going to help the quality of an audit. They need to focus on the auditor and trust their skills. A principles-based approach focuses more on the qualitative as opposed to quantitative measures. The auditor should look at the overall picture and not focus on the low-level details. When all the little details come together, it might not present a fair and true picture. But the auditors will think it did because they followed all of the standards. Principles goes beyond the requirements of standards, so rules just encourage you to do what's required and nothing more. They transfer the responsibility of judgment to the regulators as opposed to the auditors. Business environment is constantly changing, so instead of rules becoming outdated and have to constantly change them, principles would pretty much work for a changing environment, any circumstance. So rules weaken the quality of an audit because they're a substitute for proper training. If you have so many rules to follow, then you won't need to use your professional judgment. It kind of lowers the professional status of an auditor because anyone can kind of read and follow the rules. Rules are easily manipulated. Auditors can find loopholes in them instead of giving a high-quality audit with proper feedback. People have an avoidance mentality, and they just look at an audit in a certain way based on the rules because they don't want to get disciplined for doing something wrong or go beyond the minimum requirements. And the documentation requirements mainly benefit the regulators for compliance purposes because too much time is spent on compliance and work instead of focusing on the quality of the audit itself. And the rules are put in place to enable the auditors to defend themselves so they can say, you know, don't sue me, I followed the minimum requirements, instead of really focusing on what an audit is really about. And lastly, like I mentioned earlier, rules focus on the lower level details instead of the big picture, so you're not necessarily getting a fair and true view. So now Sushila is going to talk about the details of the difference in the auditing standards.
Hi, I'm Sushila, and I'll be talking about the differences in the auditing standards of US and UK. The major difference is the use of another auditor for part of a group report. Before getting into that, let me explain the responsibility of a group auditor. The group auditor or a principal auditor is responsible for providing the audit opinion on the group financial statements. Components of the group financial statements can include subsidiaries, associates, joint ventures, and branches. The component may be audited by the group auditor or may instead be audited by a different firm auditors known as the component auditor or the other auditor. In the UK, ISS do not permit the auditor's report on the group financial statement to make references to a component auditor unless otherwise required by a law or regulation to include such reference. This also applies to the reference reference to the work of an auditor's expert. However, in the United States, it is permitted to make references to the audit of a component auditor in the auditor's report of a group financial statements. Here in the United States, auditors have the option whether to refer the work of the component auditor in the audit report, or take the whole responsibility and not refer to the component auditor. In either case, the principal auditor should make inquiries concerning the professional reputation and independence of another auditor, and if necessary, also visit the other auditor and review the audit program and the working papers of the other auditor. In case of United Kingdom, since it is not allowed to make reference to a component auditor in the report, they must communicate with other auditor in a timely basis and establish an understanding of the component auditor's professional competence. To be specific, the principal auditor or the component auditor and the component auditor should work together to come up with an opinion. Now moving on to the next one, going concern. Let me first explain what going concern means. Going concern is a term for a company that has the resources needed in order to continue to operate indefinitely. If a company is not a going concern, it means the company has gone bankrupt. In other words, this refers to the company's ability to make enough money to stay afloat or avoid bankruptcy. UK standards require the auditor to inquire of management as to its knowledge of events or conditions beyond the period of assessment used by the management that may cast significant doubt on the entity's ability to continue as a going concern. It requires the auditor to concern the same period as that used by the management in their assessment, that is a period at least but not limited to 12 months from the balance sheet date. However, in the United States, the US standards requires the auditor to evaluate whether there is a substantial doubt about the entity's ability to continue as a going concern for a reasonable period of time. That is, it limits the foreseeable future to 12 months from the date of the financial statements being audited. This is a major difference, but the other difference is in the language. US use the term substantial doubt in addressing the going concern problem, whereas the UK uses material uncertainties. This is the difference, but there is a major similarity in the going concern standard of both countries. The similarity is that if there is a substantial doubt about the entity's ability to continue as a going concern, then the auditor should disclose this information and include an explanatory or an emphasis paragraph in the audit report to reflect the auditor's conclusion. Additionally, if the auditor concludes that the company's disclosure with respect to the company's ability to continue as a going concern for a reasonable period of time are inadequate, a departure from GAAP exists, which, if material, requires the auditor to issue a qualified or an adverse opinion. So no matter what the future results are, one should always keep in mind that any judgment about the future is based on information available at the time at which the judgment is made. Subsequent events can contradict the judgment, which was reasonable at the time it was made. That concludes my part, and now I'd like to hand it to Paul, who will talk about the other differences in the auditing standards.
Thank you, Sushila. My name is Paul, and I'll be talking about some of the other differences that we found between auditing standards in the United States and UK. So, as was mentioned earlier, UK follows international standards on auditing, which we refer to and will refer to ISAs. And as also was mentioned by Brianne, UK has more of a principle-based approach to audit, and versus US, which has more of a rule-based approach. And so we'll kind of get into the audit documentation, which is discussed in ISA 230. And as I mentioned just a little while ago, the US and UK do follow a different approach. US standards are more perspective versus UK standards, where a lot of emphasis is put on the actual professional judgment. And to kind of give you a quick example, US requires preparation and maintenance of an engagement completion memorandum, whereas UK does not have such requirement. And so And so the audit also, I guess, requires the auditor to include abstracts and various copies of significant contracts in their audit documentation package when they're completing the audit, versus UK, where the IS 230 states that they may include if they feel like it might be important, but it's not a necessity and it's not a requirement. So let's talk about a little bit about the audit documentation. And so the audit documentation actually serves several purposes. Obviously, it's required for the audit, to complete the audit, but it also assists the engagement team to plan and perform the audit. It assists members of the engagement team responsible for supervision and to direct and supervise the audit work. Also enables the engagement team to be accountable for its work, and it retains a record of matters continuing significance to future audits, which means they can use the audit work that's for future years, and also enables the conduct of external inspections in accordance with applicable laws. So this is talks about basically a government entity going in and reviewing the work of the auditors. So there are some similarities between the International Standards Auditing and U.S. GAS, but obviously the ISAs put a lot of emphasis on professional judgment, and they are not rule-based. And so to kind of tell you what the documentation must include, that important factor in determining, because a lot of things emphasize professional judgment, important factor in determining the form, content, and extent of that audit documentation is of significant matters will be based on professional judgment and exercise in performing the work and evaluating the results. And also documentation of that professional judgment made or significant serves to explain how auditor came up to the conclusion and came up with the opinion on that audit report. And now we'll jump to ISA 265, which is assessment and reporting on internal controls, which also has some differences. And so ISA 265 deals with the auditor's responsibility to communicate appropriately to those charged with governance and management deficiencies in internal control that the auditor has identified in an audit of the financial statement. Now, the biggest difference is that auditors are not required to express an opinion on the effectiveness of internal control, and so they just need to have an understanding. And so it states also that the auditor is required to obtain that understanding, which will be relevant to the audit when identifying and assessing the risks of that material misstatement. And in making those risk assessments, the auditor considers internal control in order to design audit procedures. So they use their assessment to actually design how the audit will go and which areas might be more high risk. And so they design their approach based on that. But again, it's not for the purpose of assessing the effectiveness of the internal control, which was, if you think about it, the reason that U.S. has that requirement, it has the requirement of integrated audit, is because of the Sarbanes-Oxley of 2002 Act, which requires auditors in the U.S. to evaluate both and express an opinion on both the financial statements and the effectiveness of internal control. The UK was not affected by that legislation, and therefore they didn't really follow that at all. Also, another important thing that we found out is that the ISA 265 does not identify, does not include a definition of what material weakness is, and so they really have no guidance on how to identify or how to identify that material weakness. Which all this goes together to saying that, again, a lot of emphasis is put on the professional judgment versus following a certain set of rules that GAS mandates in the U.S. So, and this concludes my part, and I will pass this on to Robert, who will talk about the audit report. Thank you.
Thank you, Paul. I'm Robert, and I'm going to compare the audit reports between the United States and the UK. In this situation, the United States auditing standards will apply if the audit is being performed for the benefit of the parent company. That is, the company that falls under the jurisdiction of the PCAOB. So first, I will review the U.S. audit report before moving on to review the UK audit report. As required by the PCAOB auditing standard number 1, the report title would read Report of Independent Registered Public Accounting Firm. The report salutations, typically the board of directors and the shareholders. The first paragraph, the introductory paragraph, must identify the financial statements, clarify management's responsibilities for the statements, and the auditor's responsibilities to express an opinion on the statements. The second paragraph, the scope paragraph, must identify the auditing standards used, and in this case must read the standards of the Public Company Accounting Oversight Board, United States, as required by the PCAOB standard number 1. The third paragraph, the opinion paragraph, must state whether, in the auditor's opinion, the financial statements present fairly in all material respects the financial statements, the financial position of the company in conformity with GAAP, as required by the PCAOB's fourth standard of reporting. Now, if the audit is being prepared for the UK market, then international standards on auditing, UK and Ireland, would apply. The UK audit report includes all the elements of the US audit report and much more. The title should read Independent Auditor's Report. In the UK, the report is addressed solely to the shareholders of the company and not to the board of directors. The opening paragraph identifies the financial statements and the framework applied, which is IFARS as adopted by the European Union and as applied in accordance with the provisions of the Companies Act 2006. In the UK, the Companies Act 2006 was a complete makeover of the laws pertaining to the companies in the UK and also affected the auditor's report. For example, the audit report, the UK auditors can now disclaim responsibility to parties beyond the company and shareholders in an effort to limit their liability. Next, the auditor states that directors of the company are responsible for the financials and must give a true and fair view of the state of the company. Furthermore, the auditors describe the responsibilities to comply with the Auditing Practices Board's ethical standards for auditors. The scope paragraph typically refers to the Auditing Principles Board's website that provides a standard explanation. And therefore, rather than including that language in the auditor's report, the scope language states that evidence was obtained sufficient to give reasonable assurance that the financial statements are free of material misstatement, but adds the phrase, whether caused by fraud or error. The UK opinion is a three-part opinion. The first, the financial statements give a true and fair view of the state of the company. Second, the statements are IFARS as adopted by the European Union. And third, the financial statements are prepared in accordance with the Companies Act 2006. Some of the UK companies add a separate opinion explaining they comply with IFARS as issued by the International Accounting Standards Board, in addition to their legal obligation to comply with IFARS as adopted by the European Union. Furthermore, an additional option paragraph, or opinion paragraph, is prescribed by the Companies Act 2006, which requires the auditor express an opinion on the director's remuneration report, that it's properly prepared, and the director's report for financial years, for the financial year, is prepared consistent with the financial statements. The last paragraph of the report must comment on regulatory matters. So to summarize, the differences. The UK audit report is only addressed to shareholders. The accounting principles are IFARS as adopted by the European Union. The statements must comply with provisions of the Companies Act 2006. The auditors must acknowledge compliance with the Accounting Principles Board ethical standards for auditors. The auditors can disclaim responsibility to parties beyond the company and shareholders to limit their liability. The scope paragraph adds the phrase, whether caused by fraud or error. Companies' opinion paragraph states the financial statements give a true and fair view of the state of the company rather than present fairly in conformity with GAAP. The UK audit report must provide an opinion on director's compensation and director's report for the financial year, as required by the Companies Act. And finally, the UK audit report must comment on other regulatory matters by exception. These are the issues to keep in mind as we audit the foreign subsidiary of a U.S. multinational. Thank you.